For the past decade or so, there's been one undisputed king in the world of venture capital: software. But that reign, it's over. We're going to break down the massive shift that's happening right now in innovation and finance, and what it means for, well, pretty much everything.
You've probably heard this quote from Mark Andreessen. For years, it was more than just an idea, it was gospel. The thinking was pretty simple. Every single industry, from how you get a ride to how you order dinner, would eventually get completely consumed by software. And for a long, long time, he was absolutely right.
And that's the billion-dollar question, right? What happens when software has eaten just about everything it can reasonably digest? Well, you get a really bad case of indigestion. And that, right there, is exactly where the venture capital world finds itself today.
All right, so let's rewind a bit and talk about this incredible golden age. It was a time of just unprecedented growth, and it was all fueled by this perfect marriage between an industry and the people funding it.
I mean, this model worked, and it worked brilliantly for the better part of 15 years. It really kicked off around 2008, picked up a ton of steam by 2012, and then just ran red hot all the way up until 2022. It felt like a totally unstoppable force, just minting unicorns and completely reshaping our daily lives.
So why was software such a perfect dance partner for venture capital? Well, it all came down to this really unique financial setup. You could accept that most of your bets, they were probably going to fail. Why? Because the companies that succeeded didn't just win, they grew exponentially. Thanks to things like network effects and virality, one single big hit could pay for the entire fund and then some, making all those other failed bets totally worth it.
And this right here, this model, is the secret sauce for why the US became the absolute center of the tech universe. Its venture ecosystem was so deep and so sophisticated that a founder could fund their company from the very first dollar to a massive IPO entirely with equity. You just went from one funding round to the next, marking up the valuation along the way without ever needing another type of money.
But like any great feast, it eventually has to end. The model that seemed totally invincible started to show some pretty serious cracks. So, welcome to the Great Indigestion.
That was the year, 2022. That's when the music stopped. The software bubble, which had been supercharged by all that pandemic-driven demand, finally burst. And when it did, it revealed that this eat the world model had very, very real limits.
Now, this is crucial. This isn't just a market downturn. It's something much more fundamental. The economist Carlo de Perez has a term for this: the maturity phase. It's what happens after that period of explosive growth. The technology's adoption just kind of hits a plateau. You could say we've reached peak software.
And here is the big lesson we all had to learn, kind of the hard way. You just can't turn everything into software. Huge parts of our economy, the ones that build things, move things, and power things in the real world, they can't be completely digitized. They're made of atoms, not just bits.
And that realization is pushing innovation into its next big wave. So if it's not pure software anymore, what is it? Well, it's a return to the tangible, to the physical world.
These are the new frontiers. We're talking about things like advanced manufacturing, next-gen robotics, new energy grids, space exploration, and sophisticated defense tech. Now, in these companies, software is still a huge piece of the puzzle, for sure, but it's not the entire product anymore.
And here is the core of the problem for the old VC model. Building a factory or a new power plant or a rocket company, it takes an immense amount of capital. And trying to fund all of that with just equity, the way you would an app, is just incredibly diluted for the founders. It's just not enough. The old playbook, it just doesn't work here.
So, what does the new playbook look like? Well, it requires a massive shift in mindset for investors. You're going from simply writing checks to becoming something more like a financial architect. Let's put these two models side by side, because the difference is night and day. The old model was a simple assembly line of equity rounds. The new model, it's way more complex. It requires what people call merchant banking skills, which is really the ability to build a cohesive capital stack from lots of different kinds of funding.
So what is this capital stack? Think of it like building a financial layer cake. You might start at the bottom with some government grants for research. Then you add a layer of credit from banks. For big projects, you bring in project finance. Then, maybe you secure a strategic partner who brings in capital and helps with distribution. And only at the very top do you add that final layer of high-risk venture equity. It's a crucial piece of the puzzle, but it's not the whole game anymore.
Okay, so this fundamental change in how we fund innovation, it has massive global consequences. It could actually reshuffle the entire competitive deck on a global scale.
This shift could dramatically change the balance of power, especially between the US and Europe. The US's greatest strength, its incredibly deep, equity-only VC market, is suddenly less of a killer advantage. Meanwhile, Europe, with its long history of complex industrial financing and patient government capital, might just find itself perfectly positioned for this new era.
And really, this is what it all boils down to. The rules for winning in the 21st century economy have changed. Being the best at funding software isn't the only thing that matters anymore. The ability to fund and build tangible, world-changing companies, that's back in the spotlight.
Which leaves us with this one last crucial question. An entire generation of investors has been trained to just write checks for software. But as innovation moves from bits back to atoms, back to the physical world, can they learn the old craft of actually building companies? The future of innovation might very well depend on that answer.